Welcome to our course on insurance principles here on the Learn As You Go Academy channel. Let's start with a simple question. Why does insurance even exist? The short answer is risk. No risk, no insurance. But here is the key point most people miss. Not every type of risk can be insured. When we talk about risk, we are really talking about the chance that something bad might happen. That bad thing could be losing money, damaging property, getting injured, or becoming legally responsible for someone else's loss. Risk is about uncertainty and possible loss. From there, risk splits into two very different paths, and understanding this difference is essential. The first type is speculative risk. The second type is pure risk. They may sound similar, but from an insurance perspective, they are completely different. Speculative risk is any situation where two outcomes are possible. You might lose money, or you might make money. Starting a business is a perfect example. The business could succeed and generate profit, or it could fail and result in a financial loss. The same idea applies to buying stocks, trading crypto, or gambling. There is risk involved, but there is also the possibility of gain. And this is the critical rule. If there is a chance to profit, insurance steps away. Insurance companies do not insure business success, stock market gains, or betting outcomes. Insurance is not designed to protect decisions made in pursuit of profit. It exists to protect people from losses they do not choose and cannot control. For this reason, speculative risk is not insurable. Now let's look at pure risk. Pure risk works differently. There is only one possible outcome, and that outcome is loss. There is no upside and no winning scenario. If you own a car, you face the risk of an accident. If an accident happens, you might be injured. Your vehicle could be damaged or destroyed, and you may have medical bills or legal responsibilities. What you cannot do is benefit from the accident. There is no situation where crashing your car puts you ahead unless fraud is involved, and that is illegal. That is pure risk. Insurance uses a very simple test to decide whether something can be insured. First, is there a chance of loss? Second, is there a chance of profit? If the answer is yes to loss and no to profit, then the situation involves pure risk. And that is the type of risk insurance is built to cover. This is why insurance applies to events like fires, accidents, theft, liability claims, illness, and injury. These situations only create loss. They do not create opportunity. Insurance does not prevent these events from happening, but it reduces the financial impact when they do occur. So the distinction is clear. Speculative risk involves the possibility of loss or gain and is not insurable. Pure risk involves only the possibility of loss and is usually insurable. Once you understand this difference, insurance concepts stop feeling abstract. You are no longer memorizing definitions. You are understanding why insurance exists and what it refuses to cover. And that understanding becomes the foundation for everything else you will learn in insurance.